Hi, everybody. This is Peter Schiff. It is Friday, January 10th, 2014. Earlier this morning, Wall Street waited with bated breath, anticipating a robust December jobs report. After all, it was going to validate their belief in the strength of the so-called recovery. The official estimate was 200,000 jobs being created, but most on Wall Street were more optimistic than that. Numbers of 225, 250,000 or more were being bandied about with a lot of confidence. And when the official number came out, it was just 74,000 jobs created. That's the lowest in more than 3 years. And in fact, if you actually look at those 74,000 jobs, better than half of them were actually temporary jobs. In fact, for all the talk about the job creation and the economic recovery in 2013, the U.S. economy actually added fewer jobs in 2013 than it did in 2012. Also, the unemployment rate did tick down from 7% to 6.7%, but that's not good news either. It didn't go down because the unemployed found jobs. No, it went down because the unemployed stopped looking. They threw in the towel and they left the labor force. Hundreds of thousands of Americans left the labor force. The labor force participation rate is now at a new low for this period. It's as low as it was back in 1978. And of course, back then, women were just entering the labor force. So it's actually much worse today than it was in 1978. And I think the labor force participation rate is actually being exaggerated by the number of people currently collecting unemployment and extended unemployment benefits. Because after all, in order to qualify for the unemployment benefits, you have to pretend that you're looking for a job. And so everybody who is collecting unemployment, well, the government pretends that they're in the labor force, even though they're not. I think a significant percentage, maybe the majority of people who claim to be looking for work are not. They're just looking for an unemployment check, and the way to get it is to pretend to be working. Now, if Congress doesn't extend the unemployment benefits, more people are going to drop off of the official unemployment rolls, and so that is going to bring the labor force participation rate down. Now, of course, some of the people that are pretending to work will actually start looking for a job, but that's not going to affect the official statistics, which already assume that they're looking. But there are a number of people who are pretending to look for work who are going to stop pretending and still not look. Maybe they'll look for another government program. Maybe they'll file a false disability claim to replace the unemployment benefits that they earned by filing a false unemployment claim. But we're exaggerating that number. Of course, everybody on Wall Street, they're saying, oh, this is an outlier. This number doesn't even count. Let's ignore it. It's just so bad, it can't possibly be true. Because people on Wall Street are claiming that this number doesn't coincide with all the positive news that's out there. Well, yes, it does, because it isn't all the positive news. It's been mixed at best. We have had some positive data points, but we've had a lot of negative data points. And of course, Wall Street looks at the economic glass as being half full. And they don't want to look at all the negative data because it doesn't jive with their narrative. So they just focus on the positive and ignore everything else. But also, beneath the surface, a lot of the positive numbers are not what they appear. When you dig beneath them, you find that the reasons for the positive number are not actually good reasons, and a lot of these numbers are just temporary. And of course, all this positive data is a direct byproduct of the very quantitative easing that everybody expects the Fed to taper. So if the Fed were to follow through with those threats, then that positive data would disappear and the U.S. economy would be right back in recession. So as far as I'm concerned, this number is valid. It isn't an outlier, and we'll see what happens a month from now, whether or not it is revised upward, or who knows, we might have a further revision downward. Now, another thing that happened this week was that Janet Yellen was confirmed to be the new Fed chairman. She is going to replace Ben Bernanke, who will be leaving that position at the end of the month. And everybody is unanimous in their praise of Ben Bernanke. He did a great job. He's a hero. He saved the economy. And people have equal confidence in Janet Yellen because they're sure that she will continue his policies, and so everything is great. But you know, if you remember back to 2006, because that's when Ben Bernanke became Fed chairman to replace Alan Greenspan. And it was exactly the same. Everybody was praising the maestro, who had been a Fed chairman since 1987. He did a great job, right? And everybody was happy and confident in Ben Bernanke because they were sure that he was going to continue the great policies of Alan Greenspan. Well, what happened 2 years into the Bernanke term is Alan Greenspan's bubble blew up. Now, of course, Ben Bernanke, he was part of it because he was at the Fed for part of Alan Greenspan's tenure, and so he went along with the bad policies. But the Greenspan bubble blew up on Ben Bernanke. The same thing is going to happen again because the Bernanke bubble is bigger than the Greenspan bubble. The monetary policies pursued by Bernanke were far more reckless than the ones pursued by Greenspan. And therefore, the bubble is much bigger. And therefore, the damage to the economy when it pops will be much bigger. So just like it hit the fan when Bernanke was at the Fed, it's going to do the same thing on Janet Yellen's watch. We're going to have another crisis early in the Yellen term that will be bigger than the crisis that we had early in the Bernanke term, and Wall Street and the government are equally as prepared. They will be equally blindsided. In fact, I think they will be blindsided even more. Because if you go back to the Greenspan period, there were more doubters. There were more people like me back in 2004, 5, 6, 7 who were critical of Alan Greenspan and who were expressing that criticism or that skepticism by buying gold and doing various things to hedge themselves against inflation. There's not that many of us left. There were some critics of Ben Bernanke early on, and as gold, went up to 1900 a couple of years ago, yes, critics were buying gold and anticipating problems and inflation. No more. Most of those voices have been silenced. In the last year or so, the doubters have become believers. Everybody is cheerleading Bernanke and welcoming Janet Yellen into the Fed, anticipating nothing but sunny skies ahead. Nobody really understands that all of the problems that they believe Ben Bernanke solved, he simply exacerbated. The U.S. economy is in worse shape than it was when the financial crisis started. We have bigger problems, and therefore the next financial crisis will be worse. The thing that is going to be different about the next crisis is I believe it's going to be a currency crisis. If you recall, the dollar had been weakening until the 2008 financial crisis. In fact, when the crisis began, the dollar was near record lows across the board. And the crisis actually began a rally in the dollar. So the dollar's decline stopped when the crisis broke out. And that's because I think a lot of people still anticipated that the Fed would do the right thing. There would be lots of bank failures and losses, and all of this would contract the economy. And so asset prices were going down, including the price of gold. I think the Fed believes it's learned from the mistakes that it thinks it made in 2008. And so next time around, there's no more Lehman Brothers. Nobody is going to be allowed to fail, and no one is even going to worry about the possibility of a bank failing because they know that the backstop is complete, that Janet Yellen will simply print whatever it takes, that there is no limit. See, back in 2008, nobody even knew about quantitative easing yet. The Fed hadn't even taken that tool out of its box, right? We all know now that it's there, that crutch is there for the Fed to rely on. So this is going to be a different crisis. Instead of being the end of the dollar's decline, the next crisis will be the beginning of the dollar's collapse. And I will anticipate that the dollar will continue to weaken until that crisis starts. Because as 2014 unfolds, we're going to get more data like the December jobs data that is going to disappoint and call into question the validity of this recovery, which I believe is an illusion, not a reality. And that's why we don't get real jobs. See, a phony recovery doesn't create real jobs. And the problem is the monetary policy that is required to keep this illusion of recovery going is the exact policy that is preventing a real recovery from taking place. But we can't have a real recovery until we fix all the imbalances, until we allow the economy to restructure, which means lower asset prices, lower real estate prices. It means less spending, more savings, more investment. And of course, that can't happen either until we get the government out of the way with fewer taxes or fewer regulations, lower taxes. We're not doing any of the things that are required to create the climate for a real recovery. All we're doing is creating the illusion. But that illusion is not going to show up with real jobs. And that's why these numbers are going to disappoint. The question is, when will Wall Street wake up to this reality that the Fed is not going to taper QE, and even if it makes a modest taper later this month, that it's not going to follow up on it. It's probably going to have to reverse, because if it does start to withdraw the stimulus, then the economic data will collapse that much quicker. But even if it doesn't withdraw, the data is still going to come down, because the bigger the bubble gets, the more air that is required to keep it inflated. So it's not that the Fed can just maintain QE at $85 billion a month. It actually needs to increase it. As the economy becomes more dependent on QE, it needs more of it. It's just like a drug addict. You build up a tolerance. I've said it many times that an economy that lives by QE will die by QE. Once the Fed resorted to this, this is what it did to create the economic growth, it can't stop. It is committed. Because the minute you take it away, you discover that the economy is actually in worse shape than before it began. You simply dig yourself into a deeper hole, but you're oblivious to how deep the hole is, because your mind is so screwed up because of the effects of all the QE. So that's what we've done. So the question is, when will the markets wake up to this reality and begin to price this in, particularly to the dollar and to the price of gold, which has been falling now for the last 6-7 months, or last year in particular, on this false belief that we have a legitimate recovery and that the Fed can remove the monetary stimulus and the recovery is going to continue. But again, the Fed is pretending that it has an exit strategy, just like people who are collecting unemployment checks are pretending to be looking for work. They have no real exit strategy, because it is impossible to do without unraveling the phony economy that is completely dependent on the continuation and on the expansion of that policy. Now, we'll see. Gold had a pretty good week in the first week of January, contrasting to the stock market, which actually was off to a rough start. I mean, it didn't really get clobbered, but I think the Dow was a little bit negative for the first trading week of the year. But it is not so far playing out the way all the bulls on Wall Street had anticipated. And I think if it wasn't for the big sell-off in gold on Tuesday morning, when gold all of a sudden dropped $30 in a nanosecond, if it wasn't for that massive sell order that drove the price down, we might have finished quite a bit higher on the week than we did. As it turned out, gold ended the week right on the highs, right at the level where that big sell order came in. And technically, to me, it looks like we've broken some downtrend. It's not 100% sure that we've seen the lows, but it's looking more and more likely that that is the case. And if gold can't go down, it's only got one way to go, and that's up, because it's not going to go sideways. I think when it stops going down, it's going to go up, and it's going to go up rapidly as people realize how wrong that they've got it, right? That it's not less stimulus that the economy is going to have, but more. And that the economy needs this stimulus forever. Everybody is talking about a real U.S. recovery, and that's where the optimism is coming from. That optimism in the dollar is based on the fact that people believe the Fed can tighten. How they can believe that, it's beyond me. Right? People talk about how, America had a vibrant economy in the 1980s when interest rates were double digit. And so we had a strong economy then with high interest rates. We can have a strong economy now. But this is not the economy of the 1980s. We have so much more debt now than we had then. Just because we can afford 10% interest rates or higher back then doesn't mean we can afford it now. We are way too levered up. We are more levered up than we've ever been in history. We're more levered up than we were in 2008 before the financial crisis. The government is more levered, individuals, corporations. We need 0% interest rates. In fact, that's not even low enough. We need negative interest rates, which is what we have when you factor in inflation, and we need the Fed doing QE. Now, of course, we don't really need it. That's the last thing we need if we want a real recovery. But if we want to maintain the illusion of recovery, that's all we need. But eventually, like all illusions, it will fade. Reality is going to rear its head. And I think what is going to bring that about is going to be a currency crisis. It's going to be that collapse of the dollar that finally forces the Fed to do the right thing, which it should have done years ago. But again, because it waited so long, it's going to be that much more painful. The real question is, does Janet Yellen even know what the right thing is? And will she do it, or will she pursue these failed policies until the bitter end, which would mean hyperinflation and the dollar turning into monopoly money? Let's hope it doesn't get that bad, but let's at least prepare for that in case it does. That's it for now. Again, this has been the first video blog of 2014. If you want more frequent updates, don't forget to tune in every day to my radio show, The Peter Schiff Show, at schiffradio.com. You can listen live from 10 a.m. to noon, Monday through Friday, or anytime you want, because we constantly loop the most recent show until the next live show is broadcast. Again, bye for now.